Hello, everyone. My name is Mark Boyer, and welcome to the Boyer Brief. I'm here with Jason Jacoby. Hi, Jason. How are you?
I'm great. How are you?
I'm doing great, thanks. Been kind of a rough week. Yesterday, we got absolutely hammered on the Dow Jones, down over 1,200 points, and so lots of people talking about that. And so we're both kind of dealing with that right now, right?
Absolutely. It's been a rough week, rough start to the year, obviously, but excited to see what fourth quarter brings, and we'll kind of dive into that today, right?
Yeah. So let's get going. Got an agenda here. Let's pull that up, and we can talk about some of the things that are important going on in the markets today. So we want to talk about the year-to-date market performance to see where we are. Some interesting things I want to just bring up in regards to where we are now compared to lows of June, and then we'll talk about the CPI reading that came out yesterday and the Fed hike rates, potentially what's going to happen here in September, and then want to finish up with some good news in regards to midterm elections. So we'll get started on that. So yeah, so this is a chart of the four different indices that are tracked this year. So this is 2022, and each of these lines is one of the industries. The blue being the Dow. You'll see the S&P as the black. The orangish line is the Russell 2000, the small cap stocks, and then the Nasdaq in that green area. You see here that year to date, the Dow Jones Industrial Average is the leading index, mostly because it's 30 multinational companies. An index of measuring those 30 versus is down 14.4% year to date. S&P down 17.49%. And 18 on the Russell 2000, and then the Nasdaq's down over 25%. 5% of that was just yesterday, so that was a rough day. In fact, we're pulling this up not to try to hide what happened yesterday, Tuesday, September 13th. So it's kind of an ugly day, but as you look at this, I just want to bring up kind of the trend you'll see from January through June, which I don't know if, you see how we hit a bottom in June around June 16th, the June 20th. And then from that period, we've been sort of turned, and the markets have tried to go back up, and actually have succeeded in retracing a lot of the lost ground through June of this year. And then just yesterday, again, we hit a big drop. But what's interesting is what we're watching closely on a technical basis is just that kind of that 3,900 area on the S&P 500. It's been held it today on Wednesday, and so I've kind of keeping my eye on that. Don't know if we'll go back and retest the lows of June, but at the moment, the markets, even with the bad numbers that came out, it's interesting to see that. We have not yet gone through the lows of just here in early September. So anyway, we'll see how that plays out. We feel like there's some support there, but we'll see how that goes.
Yeah, and interesting, just to piggyback off what you just said about retesting the lows. Some interesting stat. If you look back in history here, it's a good indicator of not exactly what's to come, right? But it just gives us a good idea of what could happen. The S&P 500, when hitting a bear market, when decreasing by over 20%, only to rally by 50% off of its lows, which from this chart you can see that it actually did do. We have never gone on to achieve new lows beyond, let's say, for example, these June 16th lows that we experienced for this year. So that's cause for optimism. Hopefully, again, just because it hasn't happened doesn't mean it won't, but history tells us it hasn't happened yet, since they've been keeping track of the markets in S&P 500. But so that's a cause for optimism, at least in my eyes there.
Yeah, I agree. So I think that's what we're watching right now. Again, doesn't mean we can't go down there and do it, but it would be historic to do so right after the run that we had. So we're positive, feeling like the end of this year we could have, if we can hold those lows, we see that being higher, especially as we'll talk about here, some of the information based on midterm elections, which we'll close here at the end. But the big news, and yeah, it's inflation, right? Inflation kind of gotten bigger here recently. So do you want to cover some of this, Jay?
Yeah, I'll run through it, and I just want to apologize to the viewers real quick here. So the second bullet point here, it says core PPI, which is the producer price index, cost of goods for the actual producers of the goods, increased by 0.4%, not 0.2%. So just want to make a quick correction there. It's 0.4% for the core PPI, producer price index, including energy and food, actually decreased by 0.1%. That's a reading of as of this morning on September 14th. But obviously our big news, as you alluded to in the previous slide there, was the consumer price index, right? Us as consumers, what are the prices that we're paying? My wallet's been burning, it's still burning. But what we can see here is that the CPI numbers actually increased by 0.1% month to month. And the core CPI, which is actually quite concerning here. So that's excluding the most volatile prices of goods of food and energy, right? That actually increased by 0.6%, over double what it was last month. So that's concerning. Obviously, these charts just show kind of where we're at in a historical perspective. But anything to add to that, Dad?
Yeah, so I think that again, so for definition, PPI, producer price index, right? That's what the wholesale inflation. So that's what the producers of making products. That's kind of their inflation numbers. That if those are high or increasing, that typically that's a foresight of higher CPI, which is the consumer price index, which is what we as consumers eat. So. The key here is that the good news is that the both indexes, these numbers are lower than they were a couple months ago. So overall inflation has dropped, but it did not make, especially yesterday with the CPI numbers, it didn't hit expectations. It was much higher. Everybody was hoping that we'd hit a kind of a top, and that's not the case. So we're still dealing with higher inflation. And we've talked about this in the past. We feel like it's going to be around for a while. And it's just something new. It's interesting if you look at this chart. I look at this chart down below, the kind of the graph of when the inflation, you see where it kind of started. And ironically, it's right around, early to 2021. And so it sort of correlates with the new administration that came in. And so not getting political here, but it's interesting to see how that did begin to explode under the Biden administration. And you wonder, again, I keep wondering and thinking that's my opinion only. I think a lot of it had to do with the energy costs. When we stopped pipelines and we were energy independent, and then decided to stop that and really push a renewable energy agenda, which is all good, love it. But just pushing that so quickly is hard on an economy that's so dependent on fossil fuels at this time. So looking forward to that longer term, but I think that push has really caused lots of internal costs that have been pushed to the consumer in lots of ways. So that's again, people disagree on that or whatever, but I think it's really ironic based on the graph that kind of is correlated between those two things. So hopefully we're seeing some signs of gas prices coming down. And because if you think about it, all those prices, any price of transportation prices go up, that all has to do with fuel. So if fuel costs go up, then those prices, not only at the gas pump right on the corner for our cars, but also for shipping, for all kinds of different, airlines, everybody's costs go up, and that gets pushed to the consumer. So that could be one of the reasons that their energy has been a big part of that. So there's other reasons, but that has been a big one. Absolutely.
Those are some great points. Really, really enjoyed that there. And obviously we can see on the tail end of that, energy has started to come down a little bit. I mean, I was paying about $7, I think, here a couple months ago, and now I'm down to in the $5s, which is still high, but that portion has at least come down a little bit. Still, I think grocery bills, I think that's what the majority of Americans are feeling the most, right? Is in the pocket right now is food costs and putting food on the table, which is concerning. But hopefully, if this is going to kind of segue into our next slide here. But with this raging inflation still almost at 50-year highs, what's the Fed going to do, right? That's the big question. And I'm going to let you touch on this. I just wanted to say one quick thing about this rate hike here in September, which we should be getting here in the next week. Is now basically we were pricing in a 75 basis points rate hike, right? 0.75% is basically called 75 basis points. That's the terminology we use. Now we're pricing in a 33% chance of a 1% rate hike. That's big. That's a big rate hike, right?
Yeah, 100 basis points. Yeah, yep. So for sure. So yeah. And which was kind of off the table just a month ago. I mean, we were all it was 75 basis points or down to 50 basis points, but now we're 75 to 100 basis points. So that happened, and that percentage went up here just since yesterday, because of the higher number. So
can you touch on? You and I had been talking about this in the office earlier. So what's the big fear here for us as advisors for our clients who, again, are just watching the news? Again, there's a lot of information to digest, but what is like a rate hike? Like, how does that work with the economy? How long does that take to feel? I mean, at one point I had no idea either. I thought, as soon as they announced rates, I never really thought about how long it actually took to get baked into the economy.
Yeah. Yeah, it's a good question. I think the key here is, and the problem has been is that the Fed, for months, the bond market was actually telling the Fed through interest rate. It's just how the market was reacting to the fixed income markets. We've had one of the worst years so far in fixed income and rate increases and so forth. And most of that was because the market was frustrated that the Fed wasn't moving quicker. They were seeing these signs of inflation and wanted to move quicker. So Fed's behind the curve, and this is not unusual. It's happened in the past. They seem to be playing catch up right now rather than having been on top of it. But nonetheless, that's where we are. And so what they're trying to do is control demand. So, prices, as we all know, basic economics, it's supply and demand. So you can try to deal in two areas. One is control supply to deal with inflation or the price of things. You can work on the supply side or the demand side. Supply side is more, lowering regulation, giving incentives and making it easier for companies and corporations to make a buck and to get products and services out by, reducing the demands on them. So it's called supply side, which is basically trying to make it easier for companies to make money. On the demand side, the way you control the demand side is you basically, you control one main reason is to control the interest rates. So you basically are trying to raise interest rates to slow demand down. What that means is, people spend less because, credit card expenses are higher, mortgages are higher. Seconds, any place where you're dealing with money, it's more expensive now with interest rates higher to borrow money to do things. So that's the idea, is controlling demand or affecting that. And it, like you said, it can take months for that. As an example, let's say, we're going to raise rates here next week. And if you have like an equity line of credit or something, you may be, somewhere on the, sometimes those types of loans they don't adjust immediately. They might be 3, 6, even 12 months out. So you may not see the increase until, 3 months from now, 6 months now, when all of a sudden that was like, whoa, I got the bill. How come our payments so much higher now? And so it takes a while in the economy for these rate increases to work themselves through. And so the Fed has it's quite an issue because they have to try to raise rates. And sometimes the numbers don't come in till later. And so you're afraid they're going to overdo it, which, that causes problems that send us into a much deeper recession than we possibly might already be in. So that's kind of the concern in the whole thing is it's and they don't always have had a great track record with that. So frankly, so it's kind of so anyway, I'd rather see them personally see them do more things on the supply side to make it easier.
Absolutely.
Not only since the supply lines are opening up also, but we're reducing some regulation and making things easier to pass through. Would really, if you increase supply and the demand's still there, then it'll cause those prices to come down. And right now there's a low supply and high demand, and so anyway, we're sort of in this quadrant right now. So
yeah, absolutely.
Hopefully it works out and we get a softer landing, but looks like it could be harder than the market's anticipating now, a harder landing than expected.
And thus the big drops in the market yesterday after the CPI numbers. So good points there. Really like that. All right, so we, last couple slides here. Big topic, obviously, we're getting ramped up less than 60 days to midterm elections. So just talking about that for a minute here, Dad, is quite interesting when you look at what do we talk about, year-end outlook last year and moving into this year, our board year briefs. What we talked about, we adjusted portfolios to add a little bit more flexibility because of midterms, right? We always said midterms are always a more volatile year for the markets. If you look at history, which the bottom left chart here shows, there, and even more so, there's a big volatility spike in the months leading up to the midterm elections. So look at August, September, October before the early November elections, and then things kind of taper out towards the year end. So that again, those dark blue bars are midterm election years. The kind of teal, lighter green, blue, depending on how colorblind you are, those are all the other years besides midterm election years. So quite interesting. But what about presidencies? I think this is kind of an interesting chart with Congress here on the right.
Yeah, I mean, it's just showing back to the 1930s, basically, of blues are Democratic presidents and red lines are Republicans, just showing that at midterm elections, the decreases, significant decrease. Usually, in most cases, there's just in this graph, there's only the 3 times where actually seats were gained, but it's just showing what happens in Congress and with under either a Republican or Democratic president in the midterms and what happens. So traditionally, whatever party's in the presidency in the 2 years later, typically they lose seats in the midterms. And so coming into this, if you spend any time or heard us talking at all, we knew going into this year that it was going to be more volatile. I mean, we were telling everybody that it's going to be a volatile years, not only because the markets had moved up and had a couple good years and are due for a pullback, but also because of the midterms. And I think this graph here on the bottom left of this is really a good graph. It's just showing all the way back to the 50s, the average returns of the black line is all other years versus the midterm election years. And it's really interesting. So you'll see that the black line, most of the time, the average returns are moving up and they're up and down, but traditionally up through the course of the year. Again, this is a longer term chart. And then the blue lines that kind of go flat from January, flat or down to January to about October. And then you'll see in October, November, December, you have typically a move up. And it's really ironic because basically markets are sort of waiting in the midterm years to see how it's going to pan out basically in November. And as that kind of becomes clearer and there's more balance put back into our government, the markets usually like a balance of power. And so when there's a dominant party in place at the moment, like it is at the moment, they like to see it more split and some balance typically. So anyway, that's interesting. You can explain the bar graphs there, but yeah, that's anyway. So that just shows it's very interesting midterm election years, just how you're usually looking for a spike towards the end of that year.
Absolutely, and you brought up a good point there. Is you look at the average annual returns in that chart at the top middle there. Unified government, obviously good returns, 10.4%. a unified Congress, so House and Senate unified, controlled by one party, different presidency, different party, 7.4%. And then you have a split Congress, so you have kind of a balance of power, checks and balances, kind of more middle of the road policy, more than likely. The markets really like that because, again, there's checks and balances in the system, 10.8% year over year return since 1933. So that's quite interesting. It's good points you brought up there. With all the doom and gloom that we've kind of talked about and recession talk and inflation, interest rates, things like that, wanted to kind of end here with some positives. I think that, well, it's always darkest before sunrise, right? And it's been a tough year so far, but again, if you look at history, tough times don't last forever. And I know we talked about that in the last Boyer brief last month in August. Was the average contractions are a lot less significant than the expansion periods in the economy. And so this bottom right chart I like to talk about is the S&P 500 return 1 year, so looking 12 months post midterm elections. So from 1 year post November election period is quite significant with an average of about 15% year over year. Obviously, some years are less, some years are more, and nothing's baked into the cake yet per se. It does fluctuate, but there are some years with, look at 1954, 55, 33%, then dating all the way back up to most recent 18, 19 midterm elections, 11.7%, well, 1 year from election period. So, is it possible that, coming into quarter 4, we get a nice little rally? Is it possible? Yes, it's possible. The next 12 months, it looks pretty good looking at history, but again, nothing's really baked into the cake, right?
No, I mean, we don't know. That's why we diversify. That's why we build portfolios based on risk tolerance and actually, needs and so forth. And so, yeah, we don't know for sure, but history would tell us that, you got a really good chance of being not only higher, but significantly higher over the next year. So once, like I said, earlier, as the interest rates bake through, kind of work through the economy and companies get a chance to adjust to it and people do as well, we usually find a equilibrium and start heading back in. The problem is if you get out, if you panic and if it's low and you haven't, you let your emotions get in under, take control. We usually do the wrong thing at the wrong time. And the biggest bounces are usually right at the biggest drops. So you want to make sure you stay in the game because you never know when those big days are going to come. So, you want to miss out on them. So anyway, continue. We just encouraging everybody listening to this and clients and so forth. If you need any help, again, navigating through the emotional part of this, please give us a call. And let's talk about where we are. And if we need to make some adjustments, we can do it. But again, feel like long-term, we still have lots of great opportunities going forward.
Absolutely. Amen to that. And kind of harping on what you just talked about as well is now's a great time to harvest, to tax harvest. You've been doing that. I've been doing that. We've been doing that for our clients and, allows us to take some losses while we can, because again, losses don't stick around forever, especially if you have solid investment strategies and portfolios. But it's time to make changes. Like you said, rebalance, reallocate, look to the next year and beyond, have that long-term mindset like we preach, and you're going to be okay, right? I mean, it's a good opportunity, which we haven't had in recent years, right? And I mean, well, last time we had, foreseeable harvesting opportunities, we had down markets at the end of 2018. Remember that? It was like around Christmas time, but we were all, on the holiday breaks and stuff, where we didn't really have a lot of time at that point. Capital gains had been paid and then the markets took a dive in December, and we ended up, I think, 8% down approximately, but don't quote me there. But again, now's a good time to kind of readjust, replan, re-strategize, and get ready for the next year or so.
Yep, for sure. It's very exciting time. Very excited about the future. There's a lot of pessimism, and usually that's market bottoms as well. So, the emotional side, it can get you, and usually the peak negative or even positive side things. When you get emotionally, um, it's emotional on both ends, right? And if you get down to the place where it's very pessimistic, it's usually because the market has already priced things in, looking out 9, 12 months. Those are usually the times when we find bottom. So anyway, Kate, say this all the time. We keep on because of our sports background. Like you can't make the club in the tub. They used to say when I played football back in the day, playing pro football, if you got hurt and you were not out on the field, you couldn't make the team, and because you couldn't get out there and have any fun and show your wares. But so I think in this deal, you got to stay in the game. You got to be on the field. You got to diversify and continue to work and put those portfolios together to help us be successful long term. So it's exciting time.
Great, good. Well, any last little tidbits of wisdom here before we let these guys go?
No, I think that's it. I mean, I think that's that's about it. Please call us. We're here to serve and do whatever we can to help you reach your goals and objectives. Right? I mean, that's what we love. We love our clients, the relationships, and so forth. And again, we know this has been a tough year. We've had a lot of good years, and sometimes you got to go through the tough ones too. But man, perseverance is key. And again, staying to the game plan is really critical.
Perfect. Amen to that. Well, thanks so much for
Right.
doing that again this month, and thank you all for listening. And we'll see you next month for a new edition of the Boyer Brief. For Jason Jacoby and Mark Boyer, signing out. Have a good day.